Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are talking about 10 different companies that are undervalued at the moment. Right now the markets are down so much, and we talked about it in the last 6 months. We're now midway through the year, and we want to see if there are more companies out there that we could potentially add to our portfolios. So the 10 companies that we're going to talk about today, some of them we've never spoken about them, in this channel and so on. So we want to look at them today and see if they will be a great addition to our portfolios. One of the things I would like you to do is obviously make sure that you like the videos, you subscribe to the channel if you haven't already, because genuinely that helps. And the other thing I would like you to do is don't just take my word for it, just make sure you do your own research. Okay, you have to do your own due diligence, because it's important. Everybody's journey is different. We've always talk about time horizon, we talk about your journey, we talk about all sorts of things, and that is something that I want you to take into consideration when you are looking at the companies that we're going to talk about today. So that's really important. So these 10 companies are in a different sectors. Okay, so let's get started straight away. I want to make sure this video is quite small, but once you've actually once we look at these videos and if these companies, and if you are interested in any of these companies, then you're gonna have to go into their website, look at the 10Ks, have a look at their financials, look at their revenue, look at their debt, look at their anything. Okay, just everything. Look at their customer base. Okay, you need to know who their customers are, who's buying their products. Okay, is there demand for their products out there? Really important. So we're gonna look at the name of the company, the sector, the dividend yield, 5-year growth rate, and we're going to look at the payout ratio as well as the dividend streak. So this will tell us how long they have been paying. This will tell us basically how much of their net revenue they're actually spending, giving it to us as a dividend. The dividend safety as a percentage according to simply safe dividend, profit margins, free cash flow, total return in the last 10 years, growth estimates in the next 5 years, Morningstar, and then obviously valuation as well as the 52-week range. So we want to know if how much these companies are down, because some of these companies are down 20, 30%, 40%, and so on. So we'll check that out. So the first company is a company that I own in my portfolio, and I've owned this company for a long time, and I'm going to have it in my portfolio for a very long time, inshallah. Okay, Microsoft dividend is not great, it's 1%. Again, it's all about the growth when it comes to this company. This company has $63 billion in cash, in free cash right now. Yes, they are in the process of buying Activision Blizzard and so on, but they are printing money like there's no tomorrow. This is by far one of the best companies in the world right now. The third or whatever it is right now, the biggest company in the world right now. So great company, financial wise is great. So 5-year growth rate, you're looking at about 9%, payout only 26%. So that means they can increase this as much as they want. Dividend streaks 15 years, safety of 99%. I wouldn't expect anything less than that. Profit margin is absolutely brilliant, 37%, almost 38%. Okay, total revenue, total returns, you're looking at about 25%. Next 5 years, they're expecting about 16% growth. Okay, Morningstar says about 26% undervalued at the moment, and the fair value is $352 per share. And right now, basically from its all-time high, it's actually down 23% from its all-time high. The next company is another company that we've spoken about here and there, and that's Nike. Nike is in consumer discretionary, 1.21 dividend yield, 5-year growth rate of 12%, payout ratio only 30%, and they have increased this dividend 37 years in a row. Safety is 99%, profit margin we're looking at about almost 13%, and they have $5 billion in the bank. Total return of the last 10 years, you would have received about 17%. In the next 5 years, they're expecting about 13% growth in terms of earnings, and right now is discounted 24%. Okay, almost 40% down. Almost 40% down. It's about $100, I think, per share right now if you look at their shares. The next company is the Estee Lauder. This company is actually they do a lot of fragrance and makeup and all that stuff. They own companies like MAC and Joe Malone and Bobbi Brown and all sorts of companies. So they have umbrella of companies within this. Is in the consumer staples. Dividend is not great, but 13 years of paying that dividend, increasing that dividend. Okay, payout ratio only 30%. 1 year. Basically just only increased that 1 year. Okay, so that year must have increased about 13%. Interesting. Safety 70%, so which is quite good. We're normally looking for 60 and above. Profit margin 18%, almost 19%. Free cash flow almost $2 billion and 17.47 total returns over the last 10 years. And next 5 years, they're expecting their earnings to grow 12% per annum. And right now, fair valued. Okay, $283 per share, but it's down about 30%, which is quite high. Next one is PPG Industrials. This company is a paint company. I own it in my portfolio. 2% dividend yield. I said the other day as well, I feel like I've neglected this company, but I'm going to start building up really a better position right now. I only own, I think, about 10 shares. So 2% dividend yield, 5-year growth rate about 8%, payout ratio 37, 50 years of pay, basically increasing that dividend. 50 years, that's dividend king right there. Safety 93%, profit margin almost 10.43% of profit margin. Free cash flow is not great. Okay, it's just below $1 billion, but fine, that's enough to pay the dividends, but obviously that's not enough to buy other companies or do anything else with it. This is one of the companies that have been impacted in terms of the COVID situation, so I'm sure in the next couple of years they will bounce back nicely. Total returns of in the last 10 years, we're looking at about 10%. Growth, 5-year growth rate of basically expected about 18%, and that's one of the reasons I'm actually still investing in this company, because of that growth rate, because of that, and the expected growth rate of the next 5 years, 18% every single year. That's huge. Fairly valued at the moment, $112 per share. In terms of target, is down about 31% so far this year. Next company is the company that I've done a video recently. If you haven't watched that, go and watch the full analysis of that company. Cisco is great company, network devices, 3.57% of dividend yield, 5-year growth rate about 9%, payout ratio 44%, and they have increased that dividend for 10 years. Safety is perfect, 91%, profit margin 23%, free cash flow $13.5 billion in the bank. And then if you own this stock for the last 10 years, you would have made about 12% every single year. And the next 5 years, they expect this to grow about 6%, which is basically where this company should be. This company is a slow grower. Obviously, they have a massive basically network of companies they work with. Okay, and obviously their devices are used everywhere in the world right now. So yes, they're like a dinosaur. They're not going to move about 10-20% every single year. But I think one of the things I like about this company is they're heading towards the SaaS model, okay, software as a subscription model kind of thing, because that is a recurring revenue regardless of whatever happens, and that's what they're working on right now. So I hope in the next 5 years they can do that, because that will be great for basically anyone that's invested in this business. Morningstar valuation is only 21% discounted at the moment. Fair price should be 54 right now according to Morningstar, and 33% down from its all-time high. Next company is the one I own in my portfolio, and that is 3M. 3M is an industrial company, amazing company. They have thousands of products, genuinely thousands of products. There's so many products. Every time you go to any warehouse, like companies that sell, if you go to B&Q or you go Lowe's and Home Depots, whatever, you will find a product that this company actually creates. 4.64% dividend yield, almost 5%. That's absolutely crazy. This is one of the companies I own in my portfolio, and they pay me actually basically a lot of my money comes through the dividend that I've received recently actually came from this company. 5-year growth rate about 6%, payout ratio of almost 60%. So again, slightly high, but not obviously to the point where it's like a REITs or whatever. So it's 60% is okay. Dividend streak is 63 years in a row. 63 years they have increased that dividend. Safety 75%, which is fine. Profit margin fee almost 16%. Free cash flow $5 billion and 7% return in the last 10 years, and the next 5 years they're expecting about 6%. Right now it's discounted 33%, $186 per share. That's what they expected. If it goes to that point, I think I will be making about $20 something or even more than that per share. 27, almost 28% down from this all-time high. The next company we're looking at is is actually consumer discretionary, is the home side of things. So they are a home builder. So they're the second largest public home builder in the United States, and basically they build home. They basically build the homes and operate for basically target first-time buyers, move up, and all of those things. I mean, they do all sorts of things. One of the things I actually like about this company is they're not just based in one area of the United States, they're actually almost everywhere. And the company's home building operation includes the construction and the sale of single family attached and detached homes. So yeah, they are one of the companies in the consumer discretionary. 2% dividend yield right now, 45% 5-year growth rate, payout ratio only 7%, 12%. 12 years of increasing that dividend, 70% dividend safety, profit margin of up almost 15%, and they have $2 billion in the bank. Total revenue, total returns over the last 10 years, we're looking at about 10%, and next 5 years, 24% per annum growth wise in terms of their earnings. That's absolutely amazing. If Yahoo Finance is right, that's the highest in this group of companies that I think I've researched today, and 24% and 33% discounted right now. Price should be about $115 per share. I think right now it's about $75 per share, and 36% undervalued at the moment. Now, one of the things from Sharia compliance side of things, I thought this company deals with mortgage side of it, but when it comes to Zoya, it actually is basically Sharia compliant, but you have to do your own research and find out if they actually deal with the mortgage side of it, because that's what I thought they do. So you have to do a little bit more research to find out about that. The next company is Lam Research. They are in the semiconductor basically side of things, sector. They are very similar to KLA. They deal with all the equipment side of things. So they don't actually make it. They make the equipment that's used in the making of microchips and so on. So 1.41% dividend yield, 34% 5-year growth rate, which is very high. Payout ratio very, very low, about 18, and the 7 years of pay increase in that dividend, 66% safety, profit margin 27%, and $3.566 billion in the bank. Total of free cash flow, that is total revenue, total returns over the last 10 years, we're looking at about 28%, and the next 5 years about 14%. Right now it's discounted 45%. Now, as we know, quite a lot of the companies in the semiconductor have been really hit hard in the last couple of weeks, so that's probably why it's almost down 50%. Okay, $720 per share. That's basically where it should be. And right now, I think it's about $400 per share. So that's another company that you could potentially do a little bit more research and find out. And is in great company, excellent financials as well. Next one is Moody's Corporation. This company is credit side of things, is very similar to SPGI. I've done videos before. They are both in the financials. 1% dividend yield, 11% 5-year growth rate, 23% payout ratio, and 21 years of increase in that dividend. Safety 83%, profit margin 32%, $1.6 billion in the bank. Total return percentage wise in the last 10 years, we're looking about 23%, and the next 5 years growth wise is only 5%. That's not great, but 5% you'll take that. But I kind of expect a little bit more than this from this company. 21% discounted at the moment, $350 per share. That's what it should be. Right now down about 30% from its all-time high. The final company we're talking about today is NXPI. Another company in the semiconductor side of things that deals with wireless connectivity solutions, such as near field communications and so on. So in terms of Bluetooth and all Wi-Fi and all that kind of stuff. 2.2% dividend yield, 50%. But this 50%, so I put a thing here that just like to remind me that 50% is not 5-year growth rate. It's just the 1 year that they've actually increased that for one. I think it was it 1 year? It's not 5-year growth rate. It's definitely not 5-year growth. I think it was 2 years or whatever it was, because they haven't been paying dividend for that long. Payout ratio 21%. Dividend streaks are 3 years in a row. Safety 60%. So again, that's not great. Okay, because normally we're looking for 60 and above, say just the borderline. Okay, profit margin almost 19%. Free cash flow $2 billion. Total return in the last 10 years we're looking about 22%. So it's a very high growth company if you think about it. Next 5 years expectation is about 11% earnings growth and 40% discounted at the moment. Price should be $240 per share, and right now I think it's about 160 something, 166 or something like that. Almost a 36% down for this year. So there you go. There's 10 different companies out there that could potentially be a great value, basically addition to your portfolios if you don't own them. Obviously, do your due diligence, do your research, find out a bit more about each one of these companies. Like I've always said to you, this is buyer's market. Okay, genuinely it is. If you are right now looking for companies to add to your portfolio, you are lucky. If you've got cash lying around, you are very lucky, because this is the time to build that dividends if that's what you're looking for. If you're looking for companies that are undervalued, companies like Adobe, for example, that's down almost to 40-50% from all-time highs. Now, these are great companies. They're not going anywhere. Nothing happened to the business itself. Okay, if we get into a recession and things like that, then yes, obviously consumer spending might slow down and this and that. But these companies, their fundamentals have not changed. I don't think they're going to change. The valuations right now are very, very attractive. So do your research, find out, a little bit more about each one of these companies. If you're interested, just dig a little bit deeper and find out a bit more information and see if there's actually a good fit for your portfolio. Because some of these companies, I'm looking at them, I'm like, okay, I'm not sure if I'm going to add Lam Research or NXP PI, because I already own a couple of semiconductor companies. Even the equipment side of things, I own a few of those. So yeah, you have to really look at your portfolio and see what's working, what's not working. I hope you enjoyed the video. If you lasted this long, give it a like, subscribe. Let me know what you own. Let me know what is in your portfolio, please. Okay, you guys need just a little bit more. Give me a bit more. Just let me know some of the companies that you own. If you own any of these companies in your portfolio, also let me know. Have a wonderful day. Assalamu Alaikum.